Debtor finance is very similar to an overdraft, but instead of being secured against property, it's secured against people's trade receivables. Accountants can help their clients by advising them to use their business assets to fund their business, which debtor finance does. By doing that, it means it's a lot easier to plan the succession of the business, but it also enables the business owners to use their personal assets for personal investments rather than locking up their personal assets to fund their business. There is a misconception that debtor finance is expensive. In today's market, it certainly isn't expensive. It is more expensive than funds secured against residential property, but not a great deal more. But what it really does do is enable the business to grow, and it certainly pays for itself. Trade and import finance is really a means by which businesses can pay for their imports without usually using security. Most banks will offer trade finance, but some debtor finance companies will offer trade finance for the smaller ticket deals or the unsecured deals. Trade finance and import finance really does help a business with their buying power. So if the accountant's aware of that, they can advise their clients to start looking at trade finance rather than just doing overdrafts. Debtor finance industry is very strong, consistently strong, because the nature of the business means that it's a more flexible product. And that means through different economic cycles, whereas the bank lending appetite may change, debtor finance doesn't, and you tend to find that debtor finance will grow at a much faster rate than business bank lending. And those figures are seen through when you look at the Australian industry statistics, but also the UK industry statistics.